What is up, UMortgage world? Welcome to the Monday market update with myself, Sean Grapevine, Director of Agent Direct, coming at you live from the Agent Direct studios here in Atlanta, Georgia, in front of a live studio audience. I am joined here this week, as with all weeks, by the Mac of the Rate Stack, the guy who has his bips for breakfast, the one who does best efforts with no efforts. He's the Baron of Bips, the Lord of the Locks. He's the Sultan of SLA. He's the king of collateralized debt. He's the Colossus of credit. Is it a hawk? Is it a dove? Only our resident ornithologist of this jungle of a market can identify them. That's right, the Viceroy of Best, the awesome, the amazing, Austin Koenig. Welcome, Austin.
There we go, Sean. That was quite the redemption from last week. That was great. That was great.
Thank you. I had to go back to what I know, back to the basics. Really, just kind of stick the landing there and redeem myself.
There we go. Love it. Love it. It was well. It's great to talk with you. I mean, we had a busy week last week. We talked about at the beginning of the week, obviously, but the introduction of August brought a lot of stuff. It was a lot of volatility. So
tell us about what we missed last week after our Monday market update and how that affected things.
Yeah, so we talked about how like each day we had a little bit of labor market data after our Monday market update last week, and we saw a lot of different things hit the market's radar. Right, we had the ADP really surprise upwards, but ADP and the job numbers come out on Friday that the BLS puts out, and BLS is Bureau of Labor and Statistics. They have been kind of I wouldn't say mismatched, but they just haven't been following each other very well. But the jobs numbers was slightly below expectations. However, unemployment rate fell, and we also see that hourly earnings are still warm. They're still trending upwards. So at the end of the day, I think the way we look at it is the labor market's resilient. It's not red hot, but it's
I mean, if I still have a job, it's pretty resilient, especially after I bombed my intro last week. So, I think anecdotally, I know, but it really is evidence of a strong labor market.
And, that's the thing that Fed has been harping on is, the labor market's been continually strong. How much pressure does it put on wages? And I'll look at like, how does wages put pressure on inflation? And I think generally they don't want to see a complete crash here, but they're kind of hoping to see maybe a 4% unemployment rate by the end of the year, or as we get into early 2024. Right now we're at 3.5%. We were at 3.6 for a while. So at the end of the day, this is an unemployment rate that's still some room to go up for the Fed to kind of feel pretty comfortable.
Sick bastards. I mean, geez Louise, come on. I mean, here's the thing. They should listen to me because I've been saying for months now the soft landing is in. Let's just let's not put the labor market on the torture rack just because that's what we thought we needed to 9 months ago. I mean, didn't CPI come in at 3% last month? Isn't it going to come in at 2 point? What are the analyst expectations for this week's CPI?
Well, the analyst expectations are actually a little bit higher than 3, and so the way that's kind of looked at too is we have to consider where the base is kind of shifting. So keep in mind the base from a year ago is now a little bit lower necessarily than what we saw some of the red hot inflations we're comparing to earlier this year that helped get some headline numbers down. So month over month though is important to look at too. So like we're only expecting 0.2%, which is a fairly healthy, not too hot month over month growth. But the thing is we might actually see a headline number above 3%, not by much. Analysts like predictions I've seen go anywhere between 3.1 and 3.3. I think the headline number that is expected is 3.3, but there's a lot of calls that might be a little bit lower than that. So I'd say within that range is kind of well within reason. Core inflation is the one that people want to see at least stay flat. At the headline number. So core inflation is going to be important to pay attention to too. A couple of things we have to, also consider is, oil prices, energy costs are kind of trickling up again. So that's not going to be helpful for headline CPI, but core is
Mhm.
not really affected by that. So overall, we have a couple of different things to consider, but regardless of that, we still have another full inflation print and other jobs numbers come in before the Fed meets again in like the second half of September. So we have a lot of data, and what you talked about, you mentioned it, soft landing is in. That's kind of what the market has been doing,
Mhm.
kind of pushing and kind of repricing for a softer landing, and that means higher rates for longer. It
Right.
doesn't
Not
mean
not great for
zero
us, right?
hikes.
Yeah. Yeah.
So with that being said, though, it's not the end of the world. But the thing is the way the rates market has been trending before this was we had a lot of inversion from, the short-term debt where we're, feeling a lot of rate hikes, and then the longer term, like 10-year, 30-year, we're well below that 2-year rate. So
Right.
essentially, we're seeing it kind of flatten it in a way of the the longer term stuff is steepening, and the short term stuff's been fairly constant over this, regardless of the data releases. It's been a lot less volatile, but at the end of the day, we're going to want to continue to see, good economic data, but not too good economic data. You know what I mean?
So what does this mean for the rest of the year, the next few months going forward for the MBS market? So we're starting to see some so like maybe people are really starting to believe the soft landing or the landing, whatever it is arriving, and we've got steady unemployment, steady low unemployment, a healthy economy, GDP growth, you know, CPI or like inflation coming under control, maybe not exactly at 2%, which seems very low for what the Fed wants, but somewhere in the threes or fours. Uh, what we've been dealing with is right, like this has been the talk of the town for 18 months now, or maybe at least 15 months. That there's no premium on mortgage-backed securities. Nobody's opened up the higher coupons on the rate stack, and that like we're experiencing margin compression, and everybody's too afraid to price out higher cost mortgages because of the EP or debt or early payoff risk. Are we is this going to help alleviate some of that concern from lenders and participants in the fixed income market? Like are they going to finally be convinced, like, hey, we live in with interest rates on mortgages in the sevens now, like just how it is.
Yeah, that's going to be a curious thing because at the end of the day, what we're going to see is this is a year of like a low supply in terms of a mortgage-backed security issuance, but there isn't a huge investor appetite. But does an investor appetite change with the amount of U.S. debt that's issued at kind of these higher rates? Do we see the spread between Treasuries and MBS come down with moderation of the longer term rates as well, where it just kind of sticks in this area and we kind of have a very predictive go forward path? I think that's what we could probably see as a little bit of recovery in terms of the strength of MBS. That's what we want to be able to see. How real does that happen? Does it actually happen? How much does it really flow down to the rate sheets that you guys see and talk to borrowers on a daily basis about? It's to be determined. But at the end of the day, what we want to see is we have to have some sort of MBS price recovery a little bit. I think that can happen with moderation within the fixed income market. MBS has been kicked in the teeth a little bit, and I think there's some room for recovery here, but it's not like super, super. All of a sudden we're gonna have tons of premium on the rate stack. It's just more
Right.
so.
It's not going to get great. It might just stop getting worse.
Let's hope so. So I think that's kind
I
of
mean,
where we go.
it's not as bad right now as it was a year ago. To be fair, and rates are higher than they were a year ago. They're higher than I've ever seen them. And but at least like we're not struggling to hit par, right? Like for a while there, it was like we were barely at par, and retail was hundreds of basis points behind. Now, I mean, there is, unless you're pricing out second homes or low down payment investment properties. like you can get to par on 95% of our product, mix. I would think. I don't know. You probably know more about that than I do, but it doesn't seem that hard right now.
Yeah, we're seeing that, and at the end of the day, it depends. Some investors are kind of opening up the top end more quicker than others are, and it's just dependent of what they want to do, right? We can't force an investor to put that up, but there are some outlets to get higher than 8.125 or getting above 7.625, which a lot of people have kind of been stuck at for the longest time this year, at the top of their conventional rate stack, right? So there is some of that getting released that helps that additional premium come into the rate sheets, be able to offer a par rate. But yeah, like I don't think there's a huge rundown that we're going to see all of a sudden. I think it's going to be gradual necessarily, and I think premium will slightly improve, but the refis, like the refi flood or the huge wave, when does that come along? It's still very muddy. No one has the crystal ball on exactly when that's going to be. And, I think a lot of people have been talking about the headlines of 5% mortgage rates are key for borrowers to really get out there, or people that are sitting on lower mortgage rates to be willing to sell their home, just from that sticker shock of, the 3% that they're
Sure.
sticking on at their current home. They want to upgrade, but they just don't feel comfortable with the rates. Getting close to that, below 6, getting closer to 5. How quickly does that come along? That's still TBD, but I think it's in the cards. It's just a matter of how quickly can we get there.
Sure. Well, I hope it takes forever. I mean, the longer, wherever there's volatility, I think I realize this is a loan officer. Wherever there's volatility, wherever there's unassuredness, right, is when there's an excellent time to be a market leader, an expert, to exude confidence, and to get people on your team. And the longer this lasts, the more opportunity there is to do that. So if there ever is, I mean, like I've never based my business decisions on when or whether there will be a refi boom. Those should just be right. Those should just be the cherry on the cake of an originator's year every 3 to 5 years. And it's the longer it takes to get there, the better it's going to be, 100%.
Yep.
And I think the amount, like, it's easy to play armchair psychologist to all these people, including myself, with 2% mortgage rates. But at the same time, it's not just rates and housing prices that are going up. Like, income is inflating at the same rate that prices are. So, I think it's like, yeah, you don't want to move from a $2,000 a month payment on your current house to a $3,500 a month payment on your next house, because like there is a lot of sticker shock. But at the same time, it's like, well, you went from making $60,000 a year to $90,000 a year in that 3 to 5 years. Like, it's actually apples to apples a better deal, because the job market has been so strong. There's a lot of competition. There's a lot of demand for workers. Income goes up just as fast, if not faster, in the last few months than housing costs. So I think that's this, like, everybody's stuck in the 2% rate is a bit of a boogeyman that like, once families grow, once promotions happen, once people run out of room, once people's equity in their house grows, like, the balance is going to fall in the favor of, let's go ahead and upgrade our house.
No question. It's about being purchase focused and always being able to execute on that. That's always going to be business that comes around, regardless of what rate people are at there. Sure, you're putting some people that are getting into 7% right now that may be in the money. Great, that's there, but it's about purchase. It's all about purchase. And that's where you can always be helpful to buyers and really real estate agent partners as well. That better than most. So at the end of the day, that's where we can really provide value, and it's always going to be there. So you have the right mindset, nonetheless.
Thank you. I try. I always am getting questions about products and lenders and stuff from my loan officers in Agent Direct. Shout out to them. Let's see if you can give us this. Give us a countdown until our next lender that we're adding on is announced. So you don't have to say who it is or what they do. Just like, 5 days, 10 days, 15 days, 20 days.
Oh, yeah, I would say probably the next. I'm going to give it 15 to 21 days. So probably the next 2 to 3 weeks. We have another lender come through. Actually a matter of which one or how many, it's TBD, but a lot of things are moving in the right direction on a couple of these that we've been working on for a little while now. So, we'll keep an eye out for that and make sure you guys are well aware. But at the end of the day, something we're constantly doing on our side behind the scenes. And, Rob, myself, and there's a special shout out to Joy on our compliance team. She's been really helpful on putting a lot of these things together and getting them cranked out for us. So it's been huge. And, we'll have even more options to choose from here very shortly.
Yeah, it's definitely a formidable team. You and Rob and Joy, who's always available and always helpful. What about? I have a follow up question to that. What's been your most surprising product that has found popularity here at UMortgage over the past few months that you didn't really think maybe was going to be as popular as it is or as easy to do, but that like you've seen loan officers have a lot of success with?
Actually, I think the 1% down, we had more than I thought we would. Generally because I think the main thing there was the AMI limits, right?
Mm-hmm.
And how much you could get for and what those borrowers are, competitive or actually looking for that, property at that percentage rate. It's awesome to see, how much we've actually been able to do that. It's actually a win-win for, everyone involved, really. It's a matter of, hey, we're helping those that are in the affordable income bucket, making sure those products are accessible to them, but also with the help of like, our partners such as UWM, be able to give them a little more assistance on the DPA side, which is great. So I think that's actually been a surprise of how much volume we've been able to do on
Huh,
that product.
that's
Well, it's not
great to
like,
hear.
yeah, it's not blowing the doors off of all of our volume. That's not like tons of our production, but it's marginally more than I thought we would be doing. So it was good to see kind of how popular that product got, especially after it just got released. And some of the changes that have happened to it as well. It's been great to see how much we've seen get going on that.
Yeah, 100%. We're fans of it too, and it's a lot of agent direct LOs are in the SPCP areas, which have been are pretty exciting because it's a lot. It's you get a big down payment assistance chunk, and there's no AMI limits through UWM. So if you're in Atlanta, Detroit, Baltimore, Chicago, Memphis, or Philly, definitely feel free to reach out to myself or any of our lovely cap markets folks. But it's a pretty cool down payment assistance program that's available just in those regions right now. So well, it's 10:18. It's time to go find some loans to send to Austin and his merry team of loan lockers. Thanks so much for being on today, Austin. Thanks everybody else for watching and listening. I hope you guys lock 1,000 loans this week.
There we
Many
go.
blessings, everybody. Have a great day.
Thank you so much. See you guys.